I'm joined by Rob Lake, who is the Senior Managing Director of Trinity Life Sciences. You and I had a chance to talk yesterday about some of the things going on in the market, and one of the items that came up is the use of private capital and how it can really fill a hole in a lot of circumstances for young biotech companies that may have a lot of different things going on. What are some of the situations where private capital makes sense?
There's a couple of really good use cases for debt financing. One of them is being able to stretch out runway to help companies achieve a certain milestone, and it's non-dilutive. So that's one good solid use case. The other solid use case is if you have secondary or tertiary programs that you don't have earmarked funding for those programs to continue the development. You can use debt financing to fund those programs that otherwise would just sit there and not progress.
Okay. As the viewers know, and as you know, I focus on the equity side of life sciences, small cap life sciences, and one of the biggest issues recently has been dilution, because a lot of equity companies have been trading at valuations well below where I feel they should be and where the company management feels they should be, and they're really hesitant to do a capital raise using equity. So that seems like another circumstance where private capital could fit and fill a hole. Tell us about the situations there where that makes sense.
Yeah, it makes a lot of sense. Again, one of the benefits of debt financing is it's non-dilutive. And it's a way to stretch runway for companies trying to hit milestones. So it's probably the best use case for debt is extending that runway to hit the inflection point and provide a bridge to the next equity financing at a higher valuation.
How do you structure your deals so that the returns are favorable for your investors? And when I'm thinking about debt, I think of like big companies like Walmart or Microsoft. There's just a yield and they return the principal at the end. There's not a lot of risk there, right? But not a lot of return either. So how do you structure yours to maybe align it a little more closely with the reward and risk ratio that we think is appropriate for these smaller companies?
Like all investment companies, we have a certain return threshold that we need to meet with our capital. The main components are the cash yield or the interest rate, some cash fees that we put in place as part of the structure. And then we also like to line ourselves up with the management team and the investors by adding a warrant, which provides some additional upside above and beyond the cash yield that I just mentioned.
I thought I'd talk about the markets for a bit and share some of your experience there. You and I have both been watching them over the last 4 or 5 years, post-COVID, as they did really well in 2021 and have kind of declined since then, both on the public and private side. What is your outlook right now on the future for the life sciences? And I'll bring up one item is, M&A is a big driver for not only valuations, but new activity, because it shows where the big guys are willing to put their money. And we've seen several of those recently. I think obesity, diabetes is one big area. But what are some of the other areas that you've seen of interest, and how do you think the market's going to react over the next 12 to 18 months?
There are some companies that are still suffering from a COVID hangover. They're at the last pricing mark was at a higher valuation than what they can get today. So a lot of folks are trying to figure out, how do I fund the company in a non-dilutive way without having to go and do a price round. And so sometimes debt can fill in that void until they get to the next inflection point and do a raise at a higher valuation. The other thing that's driving, at least in biotech, is this patent cliff. We're all hearing about this patent cliff.
Well, you actually shared something with me yesterday showing, there's how many billions of dollars of patents between now and 2030, 2031?
It's close to 300 billion.
Yeah, that's huge.
Yeah, the patent cliff is real. And so, biotech companies are looking for ways to fill in that revenue gap. They're making a little bit more aggressive bets than they normally would have. We saw it recently with a couple of early stage, when I say early stage, like phase 2 results, making some big bets here, acquiring these biotechs. So I think that's another driver. And then also, just given the current capital market markets for biotech and life sciences in general. It's pretty scarce right now, and again, you combine that with the higher valuations and people not wanting to take a dilutive round right now. Debt capital can be a good way to kind of fill in that gap.
So is that a well, there was actually a San Diego company that recently there was a bid on it, Sadara.
Yes.
I think you know those guys. I think we just were chatting about that yesterday. Yeah. But that's a good sign too. I think it was $9 billion, something like that.
9.2 billion.
Yeah,
Sadara.
Yeah, that's pretty big.
Primarily out there in phase 3, but primarily off of their phase 2 to be trial results. It's big market. If they can make it work, it's going to be a blockbuster drug.
Yeah. And what does that mean with this M&A? What does that mean for your market? I mean, is that something that at the tail end of the market, that's where you kind of get all your returns because, all the companies that you invested in are now acquired and the debt is all paid up? Is that how it works?
Yeah, I mean, that's one way we recycle our capital, and return money to our investors at a decent return. So M&A is a big piece of that. If the company goes public, that's another piece of the capital return. We'll be able to get some upside in the warrant. Also, just having another lender refinance our loan, helps recycle our capital. But to answer your question on the M&A side, it shows that there's throughput on these businesses. If I'm making an investment early on, I want to be able to see.
There's an exit strategy.
There's an exit strategy and see my capital come back to me through an M&A.
Is there any area that you think is of particular interest? I mean, oncology is usually one of the big areas, and neurogen is actually another that's kind of emerged, but it kind of never really reached terminal velocity there. But any thoughts? And so, some of the smaller areas actually might be quite interesting because there's less competition. But I'd love to hear from your vantage point what some of those areas of interest are in the space.
I think there's a lot of interest in it. It's been this way for a few years now. Is bioelectronic medicine. Anytime you can replace a therapy that may cause some systemic issues, and if you can provide a therapy that goes directly towards the source and treats the source without having to affect other areas of the body, I think that's an interesting space. And so neuromod stimulation is also another area that we're interested in, and similar concept and similar investment thesis there.